Testing. I'm not hearing you. I wouldn't hear.
Good morning. Please note that a copy of today's presentation is available on the Central Bank's website. The Financial Stability Report is also available for download on the Central Bank's website. Good morning. I am Giselle Samuel, Senior Legal Counsel of the Legal Department of the Central Bank of Trinidad and Tobago, and I will be your moderator for today's launch of the 2020 Financial Stability Report. Welcome to members of the banking and insurance industries and our fellow local and regional regulators, members of the media, viewing public, and fellow staff members. Thank you for joining us this morning to participate in this webinar on the launch of the Financial Stability Report. It is my pleasure to introduce the three presenters for today's webinar. Dr. Alvin Hille, Governor, Patrick Solomon, Inspector of Financial Institutions, and Michelle Francis Panto, Deputy Inspector, Banks, Non-Banks, and Payment Systems Oversight. The entire presentation should take about 30 minutes, and we have set aside an hour for questions and answers. I will now turn over to Patrick so he can jump right into this timely presentation.
Thank you, Giselle. Good morning, and thank you so much for joining us. I am Patrick Solomon. This slide outlines key points which we will discuss today. I will talk about matters related to the domestic macroeconomic and financial conditions, the performance of the financial sector, the manner in which institutions and households have responded to the pandemic, and the key risks and vulnerabilities. The Deputy Inspector will follow with a discussion on measures taken by the Central Bank to contain the implications of the pandemic and unwinding of these measures. In addition, she would provide information regarding the deferral program and digital banking. Governor will round off the presentation with some remarks on the pension industry in Trinidad and Tobago. The COVID-19 pandemic has undoubtedly caused significant disruptions and hardship in nearly every aspect of our lives, and it continues to weigh heavily on the domestic macroeconomic and financial conditions. Economic activity contracted, labor market retrenchments increased, and there was a sizable shock to government revenue. However, there were pockets of recovery in the non-energy sector as restrictions eased in the second half of 2020, and businesses made strides in adapting to the new norm. Inflation remained subdued, averaging about 0.6% in 2020. Our financial institutions continue to be safe, sound, and resilient. The domestic financial sector remained resilient throughout 2020, both operationally and financially, despite the contraction in the economy. Institutions have been adjusting and adapting to the shocks without significant disruption. In the banking sector, the financial soundness indicators showed that, notwithstanding the upgrade of the capital standards in May, the capital adequacy ratio remained well above the regulatory minimum of 10%. Despite difficulties faced by some borrowers in servicing their loans, the ratio of non-performing to total loans rose from 3.1% in December 2019 to 3.4% in December 2020. Loan deferrals and an adjustment to the regulatory treatment of restructured facilities helped to limit the increase in non-performing loans. Overall, there was a greater deterioration in consumer non-performing loans than business sector non-performing loans. The COVID-19 pandemic negatively impacted earnings in the review period. As of December 2020, banks' aggregate profit before tax was 2.9 billion and reflected a sharp reduction of 2.6 billion or 46.8% from the previous year. Liquidity remained comfortable, with the ratio of liquid assets to total assets increasing from 21.5% in December 2019 to 22.5% in December 2020. With respect to the long-term and general insurance sectors, strong capital and liquidity buffers were reported. However, economic slowdown and volatility in the global financial markets slowed the asset growth rate in the long-term sector. Looking at the pension sector, several pension plans have funding deficits due in part to lower than projected return on investments. With respect to the payment system, the total value of electronic payments, both large value and retail, fell. Banks promoted online banking channels and businesses promoted e-commerce opportunities in an effort to reduce in-store traffic at their establishment. All of this is elaborated in section 2 of the report. Financial institutions have adapted to the prevailing challenge with alacrity, thereby ensuring that the provision of services was not disrupted. The arrival of COVID-19 pandemic in Trinidad and Tobago was not unexpected. This allowed the institutions time to commence preparation for its arrival and shore up their defenses. Operational risk management, most financial institutions activated their BCP plans and structured work from home arrangement for staff. Financial institutions also had effective crisis management plans, as well as appropriate systems to respond to potential cyber attacks. Liquidity management, given the moderate growth in lending and to aid in the management of excess liquidity, the banking sector invested in government paper, as evidenced by the significant year-on-year increase of approximately 30% or 4.2 billion in the purchases of treasury bills. Other institutions also increased their exposure to the government through these instruments, which were issued to help fund relief efforts. A few pension plans have sold assets to pay benefits, but most plans remain liquid enough to pay benefits through their regular contribution inflows and interest income derived from their asset portfolio. Credit risk management, the banking sector introduced a number of measures aimed at helping customers, both consumers and businesses, to provide cash flow relief and facilitate the restructuring of facilities. Some insurers also granted extensions for payment of premiums on long-term insurance policies, thereby preventing the policies from lapsing. Digital services. Although banks have been promoting digital capabilities for several years, the pandemic has propelled the issue to the forefront. Financial institutions are linking risk management framework, internal controls, business continuity plans, and their cybersecurity strategy to ensure a coordinated approach to addressing the digital environment. They have also improved communication with customers regarding the utilization of digital services, together with the potential risks they may face. Let me turn my attention to the manner in which the consumers, businesses, and the government have reacted to the pandemic. The regulatory response will be discussed shortly. Consumers and households. Notwithstanding the fact that the stock of household debts remain high at 48.4% of the banking sector's loan portfolio, as at December 2020, household debt levels contracted in absolute terms for the first time since its compilation in 2003. This was due to the pandemic-related containment measures and the resultant slowdown in economic activities. Some consumers reassess their finances by adopting the following measures: offsetting loans against deposits, debt consolidation and refinancing, and delaying accessing new loans. This is reaffirming the prudent approach of households in the management of their domestic affairs. Businesses have also adopted a very cautious approach and are waiting for conditions to improve before borrowings to expand or invest. Meanwhile, there was a decline in business loans coupled with an increase in deposit liabilities. This implies a wait-and-see approach. The effect of the pandemic has been most severe in the services sector, especially travel, leisure, and hospitality. Government. Building economic resilience has come at a cost. Let us turn our attention to the manner in which the government has dealt with the pandemic. The government provided significant fiscal support during the period under review in order to secure the social safety net. In order to fund these payments, the government increased its borrowings locally and internationally in the form of loans and security. This resulted in public sector debt to GDP increasing from 65.9% 80.5% as at the end of 2019 to 80.9% as at December 2020. While we are seeing high exposure to the government in the form of debt, they are not unique in their response to funding the relief efforts to the country as a result of the economic fallout. As stated in the IMF Monitor in April 2021, the rest of the world public sector debt to GDP increased to 97.3% as at December 2020. Though the financial sector was resilient amidst the uncertain economic environment, risks to financial stability are slightly higher as the pandemic persists. Some of the key sector vulnerabilities included high sovereign concentration in the financial system, significant exposure of financial institutions to household sector, rapid digitalization in the financial services industry, high banking concentration and interconnections in the financial services industry. Although not identified as a vulnerability, we must also consider the long-term impact of environmental developments and climate change. You can refer to Chapter 3 of the report for any additional details and insight. In closing, the domestic macroeconomic situation remains uncertain within the context of the national lockdown measures employed to curtail the spread of the virus, as well as the mixed energy sector performance. This has implications for financial sector stability. The financial sector and the country as a whole has been able, in the large part, to absorb the negative impact of the pandemic. We benefited from pre-existing buffers such as the HSF, as well as monetary and regulatory measures which helped us to cope with the health and economic challenges. We want the bank to continue to remain strong so that they can help aid in the recovery effort. I now turn you over to our Deputy Inspector, who will continue the discussion.
Thank you, Patrick, and good morning to the viewing and listening public. Continuing from where the inspector left off, I will now get into some detail on some key measures implemented by the central bank at the onset of the pandemic to contain its impact on the financial system and support the ability of banks to continue to lend. These measures have been broadly consistent with global action. In March of 2020, the central bank reduced the commercial bank's reserve requirement from 17% to 14%, which caused an immediate increase in system liquidity of 2.6 billion. The repo rate was also reduced by 150 basis points from 5% to 3.5% to forestall potential tightening of credit. This triggered a decline of 175 basis points in commercial banks' medium basic prime lending rate. As banks deferred loan payments for their customers, the central bank stepped in and introduced a regulatory moratorium on the treatment of those loans, which prevented them from migrating into past due or non-performing status. And I will speak more about this particular policy measure a little later. The banking sector entered the pandemic with high capital ratios, even under the new and more risk-sensitive capital rules based on the Basel II-III capital framework, which came into force in May of 2020. Currently, only Pillar 1 of the framework, which caters for credit, market, and operational risk, is in effect. Having regard to the onset of the pandemic and the bank's expectation that institutions' capital buffers would be reduced, the central bank has delayed the implementation of other capital and liquidity buffers until January 2022 at the earliest. Due to social distancing measures, the central bank also stopped the conduct of on-site examinations and has intensified the use of virtual meetings, desk-based reviews, and has enhanced data requirements to keep abreast of developments. We have collaborated with the Securities and Exchange Commission and the Financial Intelligence Unit to issue joint guidance for the digital onboarding of clients for AML CFT purposes during the pandemic so that business can continue. Also, in the early phase of the pandemic, The central bank extended timelines for the submission of regulatory returns and audited financial statements. Perhaps due to the impact of significant regulatory reforms post the 2007-2008 global financial crisis, internationally, banks entered the pandemic with significant capital buffers. So fortunately, to date, the pandemic has not translated into financial crises. However, this may also be due to the speedy and extraordinary fiscal, monetary, and regulatory policy support measures implemented by governments and central banks worldwide. Regulators globally are now grappling with the appropriate time and terms for unwinding of COVID-19 policy measures. As things remain uncertain, an unwinding of these measures will reveal the true state of banks' balance sheets in terms of non-performing loans, with the potential knock-on impact on income, profitability, liquidity, and capital. Therefore, the IMF has made certain suggestions regarding how authorities should go about gradually lifting these measures. One recommendation involves moving away from blanket support programs in favor of increasing targeted and time-bound support of specific enterprises or industry sectors that have been more impacted by the pandemic. Example, small and medium enterprises. This type of support would need to be relaxed over time and ideally should be structured in a manner to avoid creating distortions that would impact on credit discipline and private investment decisions. Additionally, regulators must intensify supervisory monitoring and continuously assess banks' asset quality to determine when NPLs could rise to systemic levels and develop a suitable strategy to treat with emerging threats to financial stability. Regulators should also review banks' contingency and recovery plans in order to ascertain their plans for maintaining or restoring financial viability. And where established, the work of financial stability committees should be intensified, interagency cooperation strengthened, and crisis management and resolution plans developed to proactively prepare for any potential crisis. The central bank has been taking these recommendations on board. So I will now focus a bit more on the impact of the loan deferral program that was instituted by the banking sector. The first loan deferral program commenced in March of 2020 for a 3-month period initially, but was then extended twice to end by end of December. At the start of the first deferral program, over 1/3 of commercial banks' loans were deferred, equivalent to over 16 billion. Chart 1 shows that the value of the deferred loans peaked in May of 2020 at over 30 billion and thereafter declined to around 7 billion in December. The second chart shows that for consumers and businesses, most loan deferrals were in the area of real estate loans, followed by other consumer loans. The trend seen in the early period of the deferred program was largely due to the fact that banks applied an opt-out approach in that all loan payments were deferred unless the customer opted out. However, as the loan deferral period was extended in later 2020, more banks required customers to opt into the program. Due to the new lockdown measures that were instituted in May of 2021, the central bank extended a second moratorium on deferred and restructured loans for a 5-month period, May to September 2021. And based on what we are observing to date, fewer loans are likely to be deferred this time around. Let's speak a bit about the trends in payment system activity in 2020, which were indicative of the effect of the containment measures deployed during the pandemic. The use of digital banking or payment channels increased as evidenced by the increase in the volume and value of ACH payments, including internet banking, credit transfers, and online bill payments. The volume of payments via the real-time gross settlement or RTGS system, which processes large value transactions of 500,000 and over, also increased, although the value of those payments was lower, which reflected lower economic activity. Credit card payments declined both in volume and value terms, and customers also seemed to use their debit card less often, although the value of the transactions were higher. The same trend was also observed with respect to ATM withdrawals. Further, large value check payments continue to decline, which is a trend that has been occurring over the last few years. The increased use of digital channels and electronic payments and transfers is a welcome development, but has led to heightened cyber and operational risks, which must be appropriately mitigated. This then brings us to the supervisory and other priorities of the central bank over the next 5 years, which reflect the potentially long-lasting impact of the pandemic, as well as other emerging opportunities and threats. Consequently, the bank's priorities with respect to the financial systems are focused around 3 main themes. 1, ensuring a well-functioning financial system. 2, preparing for an evolving financial landscape. And 3, ensuring development of a modern and efficient payment system. Initiatives aimed at promoting financial stability include reinforcing banking sector supervision by focusing on credit and liquidity risks and continuing the bank's rollout of the Basel II-3 framework. We also intend to focus on advancing the crisis management framework, and since a new Insurance Act is in force, we will be rolling out risk-based supervision for the insurance sector. We'll also determine the way forward on pension plan reform, which the governor will address next. And we intend to significantly enhance the use of technology to strengthen the supervisory capabilities of staff and the operational efficiency of the bank. In preparing for an evolving financial landscape, the bank will determine its role in financial institutions outside its current span of control, example, credit unions and other shadow banks. We will deepen our focus on cyber and technology risk and expand the bank's market conduct mandate to ensure appropriate consumer protection and redress to consumers of financial services. Finally, in respect of ensuring a modern and efficient payment system, the bank is working on developing a comprehensive payments law and progressing feasibility assessments of a central bank digital currency, and has engaged the IMF on both these issues. This brings me to the end of my segment, and I now invite the governor to speak to you on the important issue of pension reform.
Yes, thank you, Michelle, and thanks, Patrick, for a well-presented set of issues. I just want to switch gears a bit and focus on something that is important to us all, which is living comfortably in retirement. And for those of the youths among us who think this is not relevant to you, think again. It is, and you better start preparing now. So basically, before the pandemic, we had some challenges to private pension systems in Trinidad and Tobago. And I'll focus on the private side in my discussion today. What were these? 3 come to mind. First of all, the demographics. The population in Trinidad and Tobago has been aging. Life expectancy has increased, so people are living longer. That means that you have to be preparing more for retirement. The second is the macroeconomics. Sluggish growth even before the pandemic was affecting employment and contributions. So people were contributing less, companies were contributing less. Low interest rates also affected investment returns, because when you put money in for retirement, it has to be invested. And if you have low interest rates, then that affects it negatively. Then you also have technology, underlying cyber risk. Now, the pandemic didn't make things any easier. So we had some more complications that we have to be aware of. Job losses, as Patrick talked about, affecting member contributions. Then businesses also were feeling the pinch, and closures took place. This impacted the contribution of companies. Apart from that, we had low interest rates that continued even lower, and Michelle talked about how the central bank lowered its repo rate and it affected other interest rates, etc. Capital market volatility was also a feature, particularly in advanced countries. So investment earnings of pension funds took a hit. Now, the last point is quite important, a focus on the shorter term, getting by instead of savings. Because people were so stressed by the pandemic, and to some extent are, there's a focus now on the immediate, urgent health and family needs, less employment income, pessimism on surviving the virus. People may be saying, well, I will die anyway, so why bother to save? So these are things that we have to be aware of. Now, but I'm talking about pension plans, but what really is it and how big are these? Are these important? Do they make a difference? Well, guess what? Pension plans command tremendous financial resources in Trinidad and Tobago. Specifically, over 55 billion, and I'm just talking about private occupational pension plans, over a third of GDP. This is large. Their assets under management actually exceed those of insurance companies as a whole. So you could get a sense of the scale. We're talking about quite a number of active registered plans, 182. Then you have some in the process of registration, and 76 are being wound up. So this is a huge thing. Huh? Now, most plans are what you call defined benefits. In other words, they commit to give the retirees a certain amount in their retirement, as opposed to defined contributions, where retirees put in a certain amount, or let's say the contributors, and when they retire, they get an amount based on that. But defined contributions have been growing. I won't be focusing on the national insurance system, but this is quite important for many of us. And for some, it's their only source of income. So the assets of the national insurance scheme are approximately 29 billion in 2020 and covering over 588,000 people. So this is quite a lot. The point about all of this is that this has implications for domestic capital market and overall financial stability, because we're talking about a lot of funds here. So apart from the micro aspect, you have the macro aspect. Now, the concept of private pensions is really simple. Companies put in money, employees put in money, you get a fund, you invest it, and then voila, at the end of it all, you get a monthly pension. That's it. It's not very complicated. But it is, because you're talking about the long term and you're talking about a lot of actors. So it requires a deep commitment among several actors to work together over a long period. And that adds complexity, because you need high level expertise, and you also need open, simple communication, because if you don't, people don't know what you're talking about. You invest now and it's for the next 30 years. So what are we talking about? Some of the members or some of the actors, the company, the sponsors, we have the trustees, investment team, management committee, lawyers get involved, legislators, supervisors. So it's a whole big network. People have to come together and appreciate what's going on and be able to communicate well. That is essential. Now, let's go on to maintaining a forward-looking perspective is crucial when dealing with savings for retirement. As I said, and when I referred to the youths, you start now, you think it's, well, this is a long time away, but it isn't. And you have to be thinking long-term. And this is a big difference with a lot of other financial schemes. Why is this? For many retirees, pensions actually represent their primary source of income. So if it's not adequate, well, you're in trouble. In fact, if these pensions are fixed and inflation is rampant or is very high, or even if it's low and it's fixed, then retirees find that their standards of living progressively slipping away. You don't want to have that. You have to be very careful about it. How do you go about it? Well, the first thing is education. People have to understand what is happening. The central bank is working on focusing on financial literacy program on savings for retirement to get people more understanding of it. Our supervision department recently issued guidelines to pension funds trustees to communicate better with members. So we're doing a part. In the current circumstances, as I mentioned before, there's a temptation to reduce retirement savings, because you say, well, it's a long time away, I need money now. Well, give me the money now. In fact, we have some proposals to withdraw or suspend pension contributions in the current circumstances, and this has been happening globally. Now, this has some merit for if somebody's in a really dire situation, but of course, you must have extreme care to rebuild contributions when possible and to avoid compromising the financial integrity of the pension scheme, because this is a long-term thing. One important thing is plan participants should not kick the can down the road. What do I mean? You see something coming, you see the train coming, get out of the way. You see something going on, take action as necessary. Don't wait, don't think it won't happen. Actuarial reports provide a good long-term perspective. They look at inflation, they look at demographics, look at everything, use that to make decisions now on the features of the scheme, investment decisions, sponsor and other contributions, etc. So use that as a long-term thing. Sometimes it might seem a bit abstract because it's long-term, 50 years and so, but please be aware of that and take those things seriously. Now, as I said, I won't be focusing on our national insurance scheme, but the lessons above for private pension funds are also applicable to public arrangements, such as the national insurance scheme. And you will see on the left, the cover page of the 10th actuarial review had been done a couple years ago. Take a read of it. It really looks at what happens in our national insurance system and gives 7 key recommendations based on what is happening. It looks at a 50-year span, and I would urge you to look at it and see the lessons. So turning now to what can we do, and what is the point of all this, and what are there gaps in the system? Well, we think at the central bank that there are several gaps on the legislative and supervisory fronts, and that should be addressed quickly. There's no need to wait too long. We have an opportunity. Let's get it organized. The pension laws need updating to cater most clearly for a number of things: governance, communications, oversight, enforcement, issues such as portability, and all that you could wrap into your scheme now. We had some draft set of regulations in 1969. They need to be updated. The Insurance Act was recently updated. This is where private pensions are located, but that part was not revised. Let's organize that. We need to upgrade the pension legislation, consolidate where necessary, and make amendments to the current Insurance Act, or maybe have a separate act. On the supervisory side, we are strengthening our oversight of pensions using a more risk-based framework, because 182, listen, I mean, Patrick and Michelle are good, but still there's plenty to do. So we have to do more risk-based. You have to focus on areas of greater concern. We have a policy development proposal of an occupational pension plan was issued in 2012. It's in our website. I urge you to take a look at it. We will be revising it, updating it. That's a long time, but that is a start. In our supervision, we align ourselves to the International Organization of Pension Supervisors, 10 principles of private pension supervision covering objectives, resources, confidentiality, governance, and so forth. So this gives a strong international setting that we adhere to. We still have some work to do. We want to get the legislation organized along those lines, the supervision, etc. And so yes, this is what I wanted to say on private pensions. I think it is quite important. It is something that we may not be always fully aware of, but we need to be. It has implications for the public health system, and we don't want a situation where after retirement, a lot of us are destitute, are finding it difficult to make ends meet. But we have to think about it now. We have to organize ourselves, and we have to be ready for the future. So thank you very much, and I look forward to your discourse and questions.
Thank you, Governor. We will now open the floor to questions. Questions can be asked by typing them in the question and answer box on the WebEx portal. Alternatively, you can use the raise hand feature and you will be acknowledged. We have our first question. The question is, what are the central bank's views on the financial system outlook? This question is for the Governor.
I don't know why you put me in the pot, because you have the inspector and deputy inspector, but I will take a shot. I mean, as was hinted before, we are at a delicate juncture. We have a financial system that is stable, steady, but we are not complacent. We are, as we like to put it, in high alert mode. We are very optimistic, but we have to shore up a number of things on the legislative front, supervisory front, on how we look at things. We have a number of priorities. On the banking side, we need to shore up their risk approach. We have to, as Michelle was talking about, look at how we exit from the pandemic, if there are new stresses and things that we have to deal with. So we have to look at that. The insurance side, well, we know we had these problems with insurance companies. We have to keep going with that. And pensions I talk about, but I just mentioned the individual entities. We have the whole issue of consolidation, and there was a quite exciting presentation on that, which Michelle had a couple of months ago. You could take a look at that on our YouTube channel. So the consolidation, the international coordination, we're working a lot with international regulators in the Caribbean and so forth. Then, of course, we have the credit unions, which we haven't talked about in our discourse now, but it is a looming thing that we need to be aware of, because credit unions command a lot of resources from individuals, and we have to be aware of that. So what I painted is a picture where we have a lot to do. We are optimistic of the future. We have the right capacity, I think. We have to do more. We have to engage with everybody, with the legislators to move legislative reform. We have to engage with the industry for us to have a consolidation of perspectives. We have to engage with international regulators. So I think we are quite optimistic, but we are not complacent, and we are always have to be ready for new challenges, including on the digital front and on greater capital movements across borders. I don't know if Michelle or Patrick would like to add anything to that.
Good morning. Governor summarized it quite well, in the sense that he spoke about the fact that we had pre-existing buffers, and coupled with some proactive measures to curb the fallout of the pandemic, this has contributed to the resilience and suggests some sort of medium-term recovery. Again, we will continue looking at the performance of the system and be proactive in terms of the measures that we are going to introduce in order to assist with the safety and soundness of the financial sector.
Thank you, Patrick and the Governor. We have a raised hand from Mr. Wayne Das. Mr. Das, please proceed with your question. We can't hear you. Can you speak up? We're still unable to hear you.
Okay, are you hearing me now?
Yes, we are. Please proceed.
Thank you.
Sorry, we're not hearing you. We will give you a few moments to sort out your audio, and maybe we'll get back to you. We have a raised hand from Mr. Anthony Wilson. Mr. Wilson, could you go ahead and with your question?
Are you hearing me? Morning.
Yes, we are. Please proceed.
Morning. This is a question for Governor Blair. Very pertinent to your raising of the issue of operation of pension plans. It refers to the fact that many people who are members of pension plans face great difficulty in getting information from those pension plans. I'm speaking personally, but I'm also referring to a vast number of people, for example, the OWTU trying to get information on their pension plans. My personal situation refers to Guardian Media. I simply asked them for an annual report, and there is no response from them. What can the central bank do to ensure that pension plans are more responsive to the requests of their members?
Thank you for that very, very important question. And I'll give you my perspective, being at the central bank and also being part of the central bank of Trinidad and Tobago pension scheme itself. I think we have to change our attitude towards information. Information tends to be something that is closely guarded. It is a secret. It is mysterious. But no, if we have people have invested their money, they have a contract for a pension arrangement. The company puts in money, it is invested. There should be no mystery. I think historically we have had that mindset, but we need to change it. As I said, we have set out something on communication of trustees with members, and I think we want people to follow that. But I believe part of the approach would be to get the legislation to focus squarely on providing information, and also the industry to coalesce and realize that information should not be secret, where unless it is something like, let's say, a union may not be able to ask for someone's confidential information for Tony Wilson's report, but they could find out, or people could find out, well, what is the status of it? So I believe it's a transition. We are doing our part to encourage trustees, members, companies, sponsors, that is, to provide more information to the individual on their own contributions and their an annual report on that, to provide the actuarial reports, to provide investment summaries and so forth. I don't think it's difficult, but it will take some time and it will take a change in mindset. We are ready for it. We will be pushing it. And I don't think it is very difficult actually, because in the US, it is normal. People get, if it's a defined contribution, they get the statements of the 401k easily, you know, the thing, they could get it on the website. Look, we have the annual, the NIB has their triennial actuarial survey on the website. So it is possible. So we will do our part. I think the media could also do its part by promoting this. And I think we can make it happen. I don't think it's that difficult conceptually.
Thank you, Governor. We will proceed again to Mr. Wayne Das. We'll try again, and hopefully your audio will be working this time. Can you proceed with your question? Mr. Das?
Yeah, hi, are you hearing me now?
Yes, we are.
Okay, my question is really on the pension plan reform. And I was wondering if, as part of the reform, is there a plan to look at the allowable investments in the pension plans, you know, in terms of possibly widening the investments, maybe the limits, maybe the asset classes, so that essentially there could be, you know, a better risk-adjusted return, which would help with boosting the returns on these pension plans. And you know, and I'm saying, of course, within the limits of ensuring that the pension plans are solid and there's capital preservation for the long run. But some level of you know, some level of widening of the existing limits might actually allow for better returns on a risk-adjusted basis. Thank you.
Well, perhaps I could take a shot at this, and just to I like this question a lot, but just to put it broadly for, you know, the people who may not be aware of some of the details on this or the concept. The funds are a lot, and they have to be invested, and they have to earn a certain amount. So how do you do that? You try to get the best investments. So what Wayne was talking about is that there are certain limits set in legislation or in guidelines, I don't know, that says you could only do up to a certain amount. Well, there are two aspects to that. First of all, the macroeconomic aspect. The legislators or the government at the time, they set some broad limits on how much you can invest abroad, how much anybody can invest abroad. This is based on the macroeconomic situation, based on the foreign exchange concern and all this kind of thing. So that is one thing. Within that, there is some space for movement. I think within the existing space, the trustees and investment companies need to use their room for maneuver as best as possible to be able to get the best return. I think the spaces or the limits are set out in what you call investment guidelines or investment policies by the pension funds. These should be very well calibrated based on liquidity, based on return, based on the profile of how you think things will be happening. So I think there is some scope even under the existing framework for companies to probably do better by stretching themselves and getting the best out of the current limits. Of course, you have to respect governance and you have to respect accountability and transparency. At the macro level, I think it is a discussion. I think that it's already a healthy margin that people can invest outside. And to my understanding, a lot of it is not exploited, that pension funds do not even use the margin that they have there. So there's just some thoughts on this matter. Thanks for the question.
Thank you, Governor. We have another question from an attendee. The question is, how do you believe the implementation of the ICAP will impact upon the banking sector? This question is for the Deputy Inspector.
Hi, good morning, and thank you for the question. Just to explain what the acronym means, ICAP is Internal Capital Adequacy Assessment, and it is a requirement that we plan to implement under Basel II of our new capital adequacy regulations. So currently, only the minimum capital requirements are in effect, and those requirements cater only for credit, market, and operational risks. But the institution, banks are faced with additional risks that are not covered by the credit market and operational risks. So Pillar 2 is really a risk management tool for the financial institution where they are required to adequately assess all their risks and ensure that there is sufficient capital for the risk or that the risks are adequately mitigated. And part of that ICAP process involves them doing stress testing and capital planning. So it is really a tool to aid with the risk management and improve the risk management of financial institutions.
Thank you, Michelle. We have another question. This one will be directed to the Governor. The FSR has identified high sovereign concentration as a vulnerability. What is the central bank's view with respect to the significant increase in government debt?
We have mentioned this quite a number of times. So let me split it into two. Why are we concerned about concentration in anything and concentration in government debt in particular? When assets are concentrated in any area, whether it's a company, a sector, a government, or a country, there is a vulnerability to that because anything could happen with that particular entity or company, and you have to be aware that you could be very vulnerable. So one way of dealing with it is to spread your assets across. So we have a lot of concern about concentration or related lending in any event. So the government or sovereign debt is just one aspect of it. But we have learned and we have seen in Trinidad and Tobago that over time, basically government debt is the only game in town. So people go into government debt and companies go into it. And so they may say, okay, they're making a good return. But we just have to be aware that if you put all your eggs in one basket, if heaven forbid you have a huge macroeconomic problem, then this is a vulnerability. And we've seen that in many countries in the Caribbean and so forth, where they had sovereign debt distress. We are not saying that that will happen, but we say that you have to be aware of that. Now, in terms of the Central Bank of Trinidad and Tobago's perspective on the national debt, it is basically that we frown upon undue increases in debt commitments if they are not warranted. What do I mean not warranted? In certain cases, you have to increase your debt. You have to borrow more than you are, and you have to spend more than you're earning if you don't have a choice or if the things are very difficult. The pandemic is one such, and in fact, the most dramatic instance of this, where across the world, countries are spending more than they're they are earning via taxes. In fact, they may be reducing their taxes. But we think this is clearly warranted in the circumstances. You have to be able to have your country survive. So you have to assume and you have to cater for some temporary increase in debt. However, we do believe that this should be measured. Any expenditure should be well targeted and should be precise. And you also have to assure that you do not build up expectations that become difficult to unwind. So if you have too much of fresh expenditure on programs that are self-generating in the sense that it becomes, you cannot get out of it, you could have a lot of problems. So we think a temporary increase in debt is warranted. It should be accompanied by a program to eventually wean yourself out of borrowing and then reduce it over time. So this is our approach to sovereign debt and to concentration.
Thank you, Governor. We have a raised hand from Mr. Richard Downey. Mr. Downey, can you proceed with your question?
My question, I guess, will go to the field in general. Mrs. Francis Panto talked a lot about the cybersecurity concerns and the growth in digital. I think the pandemic has really seen us move forward drastically in this front, but yet still we've seen some movement in some of the government agencies. What can central bank as their role play in helping transition some of these government agencies more so into that space, especially as we have both the RTGS and the ACH platforms? You know, pension, to me, anyone receiving a pension payment, old age should not really have to go and join a bank line at this stage. It's things that we should all be coming together as stakeholders to make it happen. So just want your thoughts on where does central bank play in helping transition those agencies over? And maybe just the public in general as well, education.
All right. Well, there are several, thank you, Richard. There are several initiatives underway with respect to progressing digitalization of the economy. The government would have mentioned that in their roadmap to recovery, and there is active movement through the Ministry of Digital Transformation in terms of transforming the government service to become more digitally enabled. So that is actually happening now, and they are working actively on progressing those issues. I think recently in June, the bank would have also discussed our plans in terms of promoting payments efficiency by promoting more comprehensive payments legislation. So that is also in train, and it will also help us to move to a more digital environment where there's more facility for e-commerce and e-payments. So this is happening currently, and the central bank's role in this will be our advocate. We are we are a regulator of the payment system, but we are also, in terms of enhancing efficiency of the payment system, looking at even our legacy systems, like our real-time gross settlement system, to see how we could enhance it to facilitate broader, in terms of updating our legacy infrastructure to ensure that it is now in compliance with the principles for financial market infrastructures, which are the best practice standards for payment systems, as well as ensuring that it's up to date and modern to promote payment system efficiency.
Add to that, as Richard, you raised the point, the banks could also work in terms of simplifying the onboarding process. We are currently having discussions with you about a simplified due diligence so that we could make the unbanked banked, and that will give them access to the digital platform so that once the government decides that they are going to transfer the Social Security benefits, they would have a bank account in which to do it. So in addition to the technology, we have to simplify the onboarding process, and we are currently working with the banks to come up with a simplified approach to opening accounts and dealing with the unbanked, because the banked individuals don't have a problem. It's usually the unbanked who would have the problem and be able to access the digital platform going forward. So you raise a good point, and we'll be coming and having a discussions with the commercial bank to actually advance this process going forward.
Thank you, Patrick and Michelle. We have a raised hand from Gabrielle Faria. Can you please proceed with your question?
Hello.
Hi, yes, we're hearing you.
Thank you very much. Thank you to the central bank for hosting this session. I was quite interested to hear about the simplified onboarding process for the unbanked. I must say that as a banked individual, I am very concerned with the challenges in continuing to be banked. As the central bank knows, we have raised this on numerous occasions where you have to duplicate the process based on the number of times you're applying, you're opening an account in different banks. We have asked about a centralized facility so that this information does not need to be duplicated for every account you have. Is there any way this could be done? Maybe through the joint organization the banks have right now. That's one question. I want to ask another question though. You know, when you look at the governor talked about the amount of money in pension of our GDP, I think he said 35%, I can't remember the exact figure. And you look at the level of return, I mean, I must tell you that I'm happy that there's the loans the government are taking, they're paying interest on, because as the governor knows, I have a concern about the loans they have taken that they're not paying interest on, but we're not going to go there. I see the governor smiling, he knows what I'm talking about. Right? So what I'm worried about is how do we, taking Wayne's question, how do we allow pension funds to access other avenues? Because we are weighting our investments. When you look at the holdings in companies now by NIB and other institutions, they're becoming major shareholders of publicly held companies. And there's such limited options. So those are the two questions. What are the thoughts on those two? Thank you.
Thank you. Michelle, maybe you can take the first question.
Yes, thank you, Giselle. With respect to the making it easier to do business and sharing information, I will come again in terms of what the work is being done at the level of the ministry to the ministry of the Trinidad and Tobago International Financial Center, for example. Sorry. Right. The Trinidad and Tobago International Financial Center now has a mandate to ensure digitization by 2023 and is working with the government to advance acceptance of e-signatures. So that work is ongoing at present. And in addition, again, I will come back in terms of the work. There's also work at the level of government with a national identity registry. So that is being done at the level of the company's registry. So there's active work that is going on now to make the process of onboarding and sharing information among the sector easier. So I think Governor will take the other part of the question.
Yes, thank you for that very interesting perspective. You know, the issue is that the macroeconomic situation is the macroeconomic situation. You could only do so much. In other words, pension funds could only invest in what is available and generate returns that are available. So, for example, in government paper or or equities or private sector bonds and so forth. Now, the dilemma is, as I mentioned before, when you have a macroeconomic or now a global macroeconomic situation that is so dire, then interest rates, returns, everything are depressed. So you have to live within that. You don't have a choice. What you hope is that the macroeconomic response allows for real interest rates to be positive so that inflation itself does not get out of hand. Now, of course, there is one way that you would get out of it, but you have to be careful. What's that way? By investing in risky ventures, by getting into exotic instruments, by investing in countries that are emerging and in some kind of high risk activities. But you have to be careful with that. So it is a dilemma. You have to try to squeeze the best out of the situation, hope that the macroeconomic environment is such that at least even if interest rates are low, that real interest rates are positive, so inflation is lower than that. But I hear you. There's only so much you can do in this circumstance, and I think what that means now is, as I was mentioning before, you have, when you work out a pension scheme and the investors are a combination of the members and the company, and you have an investment company that then does this investment, you have other parameters that have to give. So if, let's say, it is accepted that interest rates will be low, then if by depressing interest rates, your scheme ends up in deficit, a long-term deficit, then you may have to adjust other parameters. So you get into difficult conversations now of retirement age, of contributions, of benefits, and all those sort of tricky things that come in. But the reduction in rates, I think you hit the nail on the head, actually reduces the scope of what you are dealing with. In other words, it creates a difficulty for sustainability of pension plans and other things may have to give in the circumstances.
Thank you, Governor. We have a question coming from our social media platform. It's from Lisa Granham. The question is, does CBTT have plans to closer regulate banks on fees and charges applied? Perhaps I can direct this question to our Deputy Inspector.
In my presentation, I would have spoken to the enhancing the market conduct function of the bank. At present, we publish a subset of banks' fees and charges on the bank's website on an annual basis. So it looks at a certain number, a certain basic fees and charges, and it publishes for all the banks to provide the members of the public with a comparative view of fees and charges at the bank. In addition, we would have issued a market conduct guideline in 2018, which speaks to issues like how you interact with your customers, the issue of disclosure and transparency on fees and charges. So those are issues that document has been issued to the banks, and they were asked to put it on their website. We conducted a thematic review of market conduct practices last year. We published the report on the website. And so we are using our influence in terms of how banks treat customers and deal with fees and charges at the present time. As we build out our market conduct mandate, we'll determine what additional criteria we wish to place on banks with respect to their fees and charges. But generally, it's moral suasion, using our influence in terms of determining the direction of fees and charges.
In addition, we have been seeing fees and charges declining during the pandemic. When you look at the financial statements of the bank, they have given the consumers or customers certain concessions, and one of the areas they reduced were fees and charges, and this is a sign in the right direction. So a lot of the decline is voluntary by the banks, and the banks is their contribution to easing the burden during the pandemic.
Thank you, Patrick and Michelle. We have a raised hand from Mr. Richard Young. Mr. Young, can you proceed with your question?
Amy,
Yes, we are.
good morning again, and once more, congratulations, Governor, for a fantastic batting team there. It was really, really easy to understand, even for me. So it's really, really great. I think you are really communicating well. Governor, I wasn't intending to speak anything, but you know, Richard Downey's and Gabriel Farrier's comments prompted me, and I then raised my hand. And then, of course, Michelle helped me along by making it known that the TTIFC, and this is really why I'm now speaking, is a kind of a plug. But I want to make a couple of points too. We have been mandated to try to get the society towards a cashless environment. And I don't mean totally removal of cash. You know, fintech is obviously one way. So there's the need to also get the whole fintech sector going. But you know, the truth is, it's easy to say, Richard, as you know, not to have the pensioners line up. It's easy to say, Gabriel, let's centralize KYC and ML. To us, the biggest challenge is going to be the acceptance by society, the willingness to change. It is very traumatic for a pensioner to approach an ATM. Don't underestimate that. So it requires a significant amount of education, sensitivity to it. And of course, they will have the detractors. We'll have to deal with the detractors. And as Richard knows, my main message on that has always been, we have to collaborate as a country, right? We have to. If we don't, we are not going to achieve it. So us moving a country forward from a digital point of view requires benefiting from. And then even in the commercial world, there's competition, but we have to collaborate. And to me, that is what I wanted to say. I wanted to say TTIFC is involved, so thank you, Michelle. Come on, I didn't want to dominate and talk on all this kind of thing, but I wanted to make the point, particularly to those two persons who spoke. You know, Richard knows it, and Gabriel, we have to collaborate. And easier said than done. Change and education. Thank you, Governor. Thank you, Giselle, to make the comment. That's all. You know, thank you.
Okay, thank you.
Perhaps I could elaborate, and I'm glad we encourage you to express your views, because it is always you know, magical when you speak. So we really appreciate your perspective, and I couldn't agree with you more, particularly on the sensitivity part, because we have not only, I wouldn't say not only elderly, but people who may just not be into it for one reason or the next with the digital thing, or they experience serious difficulties. You may not have any charge on your phone. You may not be able to go by the ATM. So there are practical difficulties. You may not have a computer. So we have to be very sensitive. And I think what we need to do is to have a dual system where people are not left out. In other words, the majority could fall into the electronic space, but you have to have some relief valve where people are able to still do their transactions in person or with less reliance on technology, because first of all, as I said, they may not have the capacity 100%. they may be fearful, or some things may go wrong because, you know, electronic things do go wrong and you have to have a backup. So I think with all of that, we could work out a system. I am optimistic that people can move. And I agree with you 100% on the need for education, collaboration, and sensitivity as we move on this journey.
Thank you, Governor. We have another question from an attendee. Is the central bank looking at fixing some customer charter, given the timelines within which a bank will have to respond on different services sought? Perhaps I can direct this question to Mr. Solomon.
As part of the market conduct guideline, we always speak with the banks about their relationship with the customers. And most banks have a system in place where they resolve particular issues, complaints in terms of the provision of their services. So therefore, most banks are shoring up these services. If they do not work and the customer is still aggrieved, there are other avenues available. You can report the problem to the ombudsman, but you have to seek to resolve all of the issues with the banks first, then seek the ombudsman. And if that doesn't work, you can refer to the bank supervision department for further assistance. But based on my interactions with the bank, they are very proactive in terms of sorting out customer issues, because I think they run on the principle that if they take care of you in the short run, you will take care of the banks in the long run. So it is in their interest always to have a satisfied clientele.
Thank you, Patrick. We have another question for you. You noted some FSIs in the insurance industry deteriorated. Do you predict further deterioration? And if yes, should we expect any failures in the near future?
That is always a difficult question. Any regulator cannot give you absolute assurance that institutions will not fail. However, based on the financial soundness indicators, we are confident that the insurance sector remains strong and the FSI are within what we consider acceptable range. With effect to the pandemic, the impact has been on profitability, but it hasn't only been confined to Trinidad and Tobago. That has been a global phenomenon. However, we are confident that the banks continue to have strong capital positions as well as liquidity positions, and this will enable them to weather the current storm. And we also are proactive in the sense that we have in place a crisis management plan, and the crisis management plan, we have a collaboration of the different regulators. We have conversation regularly with the DIC, the TTSCC, and the central bank, and we are proactively looking at ways to deal with potential problems if they arise in the system. But currently we are confident that the FSI, which is an indicator of soundness, it remains within acceptable level. And that's the assurance that we could give, limited assurance that we could give at this point in time.
Thank you, Patrick. We have Mr. Anthony Wilson has raised his hand, has a second question. Mr. Wilson, can you proceed with your question? We are unable to hear you.
Yeah, hi. You hear me now?
Yes, we're hearing you. You can proceed.
Yes. In the report, the central bank refers to household debt and the holdings of sovereign debt by financial institutions. That information is very interesting and very useful. what I found was missing was an indication of which of those debt holdings of the financial institutions is more of a risk to them, to the financial institutions. Hello?
Perhaps I could take, or are you continuing to ask a question?
No, that was the question. If you were to balance household debt versus the holdings of sovereign debt, which would be more of a problem for the financial institutions? That's the question.
That's a very keen observation, and I'm glad you went into that kind of analysis. The two are different, and one major difference is the distribution of household debt. In other words, it is not one company, it is not one household, it is not Patrick or Giselle or something. It is thousands, hundreds of thousands. So that in itself adds a certain stability, because it is hardly likely that everybody would be distressed at one time. The thing about the government, however, is that the government is one entity. So that difference is important in assessing risk. One company, one entity versus the other. Of course, now you could say there are another dimension to the two bodies as it were. That the government is the government, in the sense that the government commands resources, it commands money, it commands policy, it could do legislation, it could do macroeconomic things, so that it has the wherewithal to be able to repay over time that an individual household may not have. So those are two dimensions that need to be taken into account. If I were to say which is more risky, I would say neither of them per se, but it depends on the circumstance. If you have a deep macroeconomic problem, let's say like Jamaica faced, or Barbados, where they had to have a sovereign debt restructuring, then both sides are risky, because the government then restructured its whole debt operation. But of course, now it's in a better footing. And then because of the major distress, then you find that people were out of work. So a sovereign debt distress does not generally come without personal distress. So I know I haven't answered your question to say, well, this one is more and that one is less, but it depends on the circumstance. But these are the kind of things that we look at: the concentration in one entity, which is the government, as opposed to a number of them. The fact that if you have a sovereign debt distress, it could be damaging to everyone, including the household. So we look at it very carefully, and we continue to monitor, and we continue to advise for people and banks and institutions to be able to spread their risk. Thank you.
Thank you, Governor. We have another question from our social media platform from Godfrey Ransom. He wants the panel to comment on indexing of fixed rate pension plans with inflation.
I notice nobody say anything, so let me get into it.
I would start.
Yes, or Patrick, you understand?
You can. Okay. Go ahead, Governor.
No, go ahead.
Defined benefit plans make periodic pension increases to combat the effect of inflation. Based on our interaction with the plan, this is usually an active discussion that is taking place. And therefore, if the plans can financially afford, the trustees will obviously have discussions with the sponsors to increase the pension that they pay to their members.
Yeah, thanks for that, Patrick. Maybe I could just look at another dimension to it. And if I were to start from first principles, as I said before, the contributors, the employees put money, the company put money, somebody invested, and they get it over time. I also made the point that the idea is to have for society or for retirees a comfortable retirement. What does comfortable mean? It means that your standard of living does not slip over time. What can affect that? Well, one thing is if you have a fixed amount of retirement income and then inflation erodes the value of it. So it starts off at $100. You could buy $100 worth of doubles, but after a while, the price of doubles gone up, but your $100 stays the same. Guess what? Less doubles for you. So you want to, I think it's a good idea to have indexation to inflation. I think it's an excellent idea to be able to have the standard of living maintained. But of course, now you have to build that into your calculations. And once you build that in, you will see whether it is worthwhile and what other things may have to give. If you have a low inflation environment and you have investments that have a very decent return and you have other demographics are stable, you don't have an aging population and all this sort of thing, then indexation is wonderful, and I would certainly advocate it if it can be afforded. In certain cases, if you have other problems with the different parameters, you may have to step back on something. You may have to freeze pensions at a certain time, and then you resume when possible, and so. But I think, in principle, I think it is a great idea, and it should be followed as far as possible and far as practicable once the scheme can afford it.
Thank you, Governor and Patrick. We have another question from an attendee. The question starts, the particular problem of insurers not being able to remit Forex may adversely impact the entire industrial sector by denial of payment by reinsurers due to non-payment of premium. Is the central bank given some thought to considering putting payments to reinsurers on par with trade?
All right. Yeah, I think we are in a system where the central bank does not dictate where the foreign exchange goes. It is a flexible system, and we do not say where the foreign exchange goes. In the macroeconomic circumstances, I think I mentioned in the last presentation we do have an imbalance in the foreign exchange market, one, and that affects everybody. It affects all companies, and we certainly want to make sure that different aspects or different components of the financial system are not unduly affected. So to the extent that reinsurers have difficulty, then we have the other component, which is the banking system. We have talked to them about also supporting their fellow institutions to make sure that we do not get a macroeconomic fallout from reinsurers not being able to provide the coverage necessary. So this is how we look at it on a macroeconomic level, but we have been engaging with the commercial banks to deal with this circumstance.
Thank you, Governor. We have another question which is directed to you. Do you think that financial institutions would be able to cope with the pandemic if conditions persist into the next year?
Find me or Michelle. Michelle, you want to take that or you want me to?
Sure, I will take it.
Yeah, go ahead.
I think a similar type of question was posed and answered by the inspector a short while ago, where he spoke to at present, the financial stability indicators are robust. Notwithstanding the onset of the pandemic, and there may be softening in some areas with respect to non-performing loans and some declines in profitability. Overall, at this point, the financial stability indicators seem sound. And we have heightened our engagement with the financial institutions in terms of meeting with them quite frequently to discuss their identification, monitoring, treatment of credit risk and provisioning. And these discussions have been very fruitful. So it gives us a sense of a very early sense of what is happening, where things are going. And at this point, right now, we do not have any immediate concerns.
In addition, the banks have been doing stress testing of their portfolio and looking and ensuring that they have adequate liquidity and profitability to deal with any unforeseen circumstances that may arise in the future. So yes, we are monitoring them and we are proactively doing so.
To just add to what Patrick and Michelle said, to add a fresh dimension. The longer this thing goes on, the more and more difficult it becomes for everyone, and financial institutions are not excluded. Now let's look at countries that seem to be coming out of this situation. Let's say in the US, they have about 70% vaccinated and so forth. The pressure on their financial system and as well as the economy has started to ease. Of course, we have to be careful because with the variants that could turn things around, but the pressure has started to ease. And so what we want is a durable exit from this pandemic. That is the fundamental thing that we need to have. To the extent that you have a population that is resilient, either through vaccination or whatever, then it reduces pressure on businesses. You can then reopen activity and things become more buoyant, etc. So ultimately, while we do have some room for still some adjustment, we would not want this to go on forever. And we think the solution is not really a financial solution in terms of what the central bank could do with prudential requirements and so forth, but really a health situation, a pandemic release situation. When we get out of that, then we'll be able to have more. We still have, as Michelle said, to deal with issues of unwinding of the measures, but still we would be in a better place. So to summarize, I think we have some resilience still, but we don't want to test this thing for too long. We want to get a durable exit so we're able to move on more strongly.
Thank you, everyone. We are starting to wind up. We'll take 2 more questions. We have another question from Mr. Anthony Wilson. Can you proceed with your question?
Yeah, Governor, this one is a follow-up to my previous question. You referred to a sovereign debt situation in Trinidad and Tobago in answering the last question that I asked. So the question is, given the escalation of our sovereign debt as a result of COVID, how far are we away from a sovereign debt situation?
Well, I mean, everything depends on the dynamics because it depends on how things are moving. What is your trajectory? Are you getting to an unsustainable point? I don't think we are getting to an unsustainable point because, first of all, we have some buffers, as we mentioned before. We have still a relatively low debt. We have the Heritage and Stabilization Fund. We have reserves and so forth. To the extent that we are able to reduce the expenditure, then you find that the deficit would decline and therefore the debt dynamics would turn around. So I think we are far away from any major problem, but and anything that would happen would take some time, but I believe the dynamics are potentially manageable. It all depends on the correct policy. And I mentioned the policies would really be on the expenditure side. That expenditure needs to be precise, it needs to be targeted, put in the right areas, and not self-generating, that you put something that you cannot get out of. And once you manage it properly, I don't think we would have a major issue, but we cannot be complacent. We cannot figure, well, okay, things are all right, so you don't have to do anything. we always have to be vigilant. We have to be looking at the numbers carefully. We have to be looking at where we get the debt from, the cost of it, is it necessary, and then how we deploy it. So with a combination of these, then I think we should be okay.
Thank you. We have come to our final question. The question is, well, it starts with a statement. I was locked out of my bank account and inconvenienced for days when my bank changed over to a new platform. What is the central bank doing to ensure that banks are better prepared to undertake such upgrades?
I'll start. What I could say is sometimes the best laid plans go awry. When things go wrong is the response that is necessary to correct the problem. The central bank recognizes that most commercial banks at this point in time taking the opportunity to upgrade their systems to provide a more convenient method for customers to access their accounts. However, there will be some technological issues in terms when upgrades are being undertaken. As a regulator, we are constantly in contact with the institution to understand the cause and the measures they have put in place to rectify and minimize such occurrences in the future. Additionally, we accept that with increased digitalization of banking products and services, cyber and operational risk will be heightened. At this time, we are conducting the cyber risk thematic review of commercial banks to determine their level of preparedness when the cyber risk occurs. At the end of the exercise, we intend to issue a report to each of the banks outlining identified gaps in their cyber resilience and recommendations to address those gaps which are in line with international best practices. We will also be issuing an industry report on cyber risk in the banking sector and the recommendations that will inform banks of measures to adopt to mitigate against such risk.
Thank you.
Thanks a lot for that. Maybe I could just add one point to what Patrick, I mean, we have a very comprehensive take on what we do. But this is a serious and scary circumstance, and I'm sure the questioner went through a lot of heartache and difficult moments, particularly given the dependence on electronic transactions, and now in a pandemic. I mean, it could really be stressed. But as Patrick mentioned, things will happen. What we believe is that banks should have a clear approach for recognition, communication, resolution of these issues, and compensation if necessary. So we will be working with them to assure as far as possible all of these components are in place. Thank you.
Thank you, Governor. That would have been our last question for today, and we have now come to the end of this webinar. Thank you for joining the Central Bank today. We certainly hope it was very informative. Please note that you can download a copy of the Financial Stability Report and a copy of today's presentation from the Central Bank's website. Additionally, a recording of the webinar is available for viewing on the Central Bank's YouTube channel. Thank you once again, and do have a safe and productive day.